Hi folks, it's us from GNAT News and welcome back. We're in studio. We've been talking with Todd Walker, who's a financial advisor. If you've watched our series of segments before this, we are on now number 4. And in this segment, what are we going to talk about?
We're going to talk about the world of financial advisors.
A financial advisor, which is what you are.
But this is what I am.
Got it.
And
he's not making a pitch. He's not doing a sales job or anything like that. He's simply going to walk us through, if you did want to hire a financial advisor, things you should look for. Is that correct?
Right, that's right. So why to have an advisor? So I'm going to just briefly go through some of these reasons. We talked in previous segments that you don't have to have an advisor. You can invest yourself by getting a low-cost discount stock brokerage and then investing that way.
Index funds?
You could use index funds. You could use mutual funds or a mutual fund index fund or an exchange traded fund.
Which we talked about, right?
We talked about that. So you can do that. You don't, and we have people. We are a lot of shows during the year, social responsible ones. So like we're at SolarFest and NOFA, and we were just at the Vermont Interfaith Power of Light, and so we have a booth and we talk to people all the time. And people come up and really at some point we'll just say, you know, it probably doesn't look like a good match. So you really want to either spend the money or whatever for an advisor. Right. Here's how to do it yourself, and we're happy to do that. Got it. But anyway, but if you want to get rid of the job of doing it, which is what we really find. Most people,
stressful.
Well, it's stressful in time, and a lot of people just and they inherit money. That's usually very often the thing. They're taking care of things in their own way and a certain amount of money, and then they get a bunch of money, and they're like, this is just too big. Right. And so then they say, look, we need help. We need help. Or they just tired of doing it. They get to retirement, and they want to travel or something, and they're like, we don't want to do this anymore. Right. So that just happens to lead in the first point. You hire an advisor to do a job that you don't want to do or don't know how to do. I mean, it's like any other professional, lawyer, doctor. You know, you don't want to stitch yourself up. You know, so financial advisor takes care of that. The advisor will help you answer questions about your risk comfort level, your goals, etc., that you may not have actually thought about, and that's very interesting. It's almost like a little bit of an interview, and people.
We talked about that in the earlier segments. How if you don't figure out your risk, it puts you at a disadvantage in a way.
Well, of course. I mean, you can invest more aggressively than you should, and we talked about originally about that you don't want to confuse investing with gambling, right? And that's something the two different styles. So the investment, I found that's to be true. I mean, I sit down with a couple, and you start going through this, and they begin to talk to each other, and they realize that they just haven't asked a lot of these questions. So it's nice to go through this process of figuring out your risk level and your asset allocation and your total savings, and are you getting an inheritance maybe which might change how you're going to invest now. So it's this question, and in our case, because we do social responsible investing, part of it is about what are your values and what don't you want to invest in. If you don't agree with them, what do you? So. And
the couple finds out if they have fundamental differences about what you should be doing, I'm sure.
Yeah, been there, but usually, it's okay.
And you've got to work that problem.
Yeah, you have to be just very diplomatic. One thing an advisor that helps with is to figure out getting tax advantages. So your accountant's supposed to do that, but accountants are not, sometimes they're not as aggressive about trying to save taxes in investing. And I don't want to say that we've worked with wonderful accountants, so don't get me wrong. But especially if they're just a tax preparer versus an accountant. If they're a tax preparer, again, love tax preparers. But sometimes they so the advisor will say, geez, have you thought about, an additional IRA for your child? Or have you thought about, going with a larger IRA, moving it from a regular traditional IRA to a SEP IRA where you could be contributing much more, or from a SEP IRA to a solo IRA, or a 401k plan for your company. So, they'll think about tax advantages. This is something that an advisor should do.
And if you were just quickly, if you were retiring and you needed to start taking distributions from your IRAs, is that also something you're there for too? Yes,
although some advisors do it and some don't. If you wanted someone to calculate how much you can take out of your account and still, not run out or something, that's typically a financial planner. So a financial advisor really is someone who really manages pots of money. I mean, in the sense of a planner looks over that, but is involved with your savings accounts and your insurance policies and everything else. So it's a little different, but yes, in a way. Then also a financial advisor should help you revise your financial plan as you age as time goes on, or your circumstances change. You have a medical emergency or something. I mean, that another person who should be there, so you say, look, this has happened, or we now want to buy a second house, or whatever it is, that this person's there to help advise you on that. The advisor also provides access to a world of investments that the client may not know about. That's our job. You know, our job is to have all sorts of sources. You know,
like real estate trusts.
Real estate trusts, and of course, all sorts of mutual funds, and to provide access that they may not be able to get on their own. Right. And investments that are lower cost than they can get on their own. Yeah. So that's another value. And look out for new opportunities. I'm just reading my list here. Look out for new opportunities that come along, new products, and new sectors like cloud computing, or you talked about marijuana before, marijuana investments. Are they right? Is this the time? Solar.
Because quite frankly, the everyday person is just not going to spend this amount of time looking at what they should do with their investments tomorrow. It's just too much work.
In fact, I meant to mention in our previous segments, thank you, that it's an old line, but it's absolutely true. Most people spend more time planning their vacations than they do. I'm sorry, than they do manage their money. And where are we going to go next? And all the so it's human nature. I mean, investing's not fun, and fixing plumbing's not fun. But you have to, you have to have a professional for both. But it's interesting what has been found over time. The #1 value of a financial advisor versus not having one is downturns. Well, upturns and downturns. Upturns in the sense that they will push you to maybe invest a little more, maybe even a little selfishly, but that's good many times. But the real one is on the downturn, because I must have fielded hundreds of these calls over the last 15 years. This is the current reason that everything's going to hell in a handbasket, and you know, I want to get out. I just can't take it. I'm really nervous. Or what do you think? And is this the time? And it's never coming back. And this is the and you just have to, having gone through that with my own investments before I even got in this business, you just see that over time you have to believe in the world. You have to believe in America, and over time, it comes back. And the worst thing you can do is to sell out at the bottom, or what appears to be the bottom. In fact, it's interesting, as an advisor, you suddenly kind of get a sixth sense after a while of what a bottom feels like. I don't know why, you just feel like, because in some ways it's kind of interesting, I start losing faith. I start thinking, wow, this really could be it. And then I know, it's time to buy. In a sense, because it's gotten to the point where the average people are, you know, already petrified, but I'm beginning thinking, whoa, you know, this is, It was tough in 2007 and 2008 to hang in there, but I did personally, and a lot of my clients did. It was funny, they didn't pull the panic button at the decline, really. Some of them were upset, but when people started talking about lining up at banks, then my clients were very concerned with the cash that was in their account. That's a long other story, but it all worked out in the end. And the last thing, that if you're interested in social responsible investing, then you want an advisor that provides that expertise. So that's all right. So how to choose an advisor?
And just before you leave that, just because I have no idea, what does an advisor cost? I mean, I'm assuming the initial "hi, nice to meet you" is free. Is that true? Maybe not.
No. I was just wondering, because I was wondering how I was going to. All right, I'm covering that later. But
no, I am.
But
we'll cover it later. No, that's all right.
No, well.
I'll hold my time.
All right. Okay. No, it's not that. It's because there are ways to look at what they cost. But so how to choose an advisor? Obvious ones: talk to your friends and associates about people they use and respect, et cetera, et cetera. You want to get referrals from an advisor. You want to get them to tell you people that they're working for. Now, they're going to pick people they've done a good job for, but you know, that means they're people they've done a good job for. And you want to get years of experience. That's really important. You want to get a biography of where they're from. When you're talking about social responsible investing, if they have any SRI experience, but just generally years of experience really means a lot. I mean, I would think, oh boy, at least 5 years to me, typically, they're going to have total control over the portfolio. You know, so that's important. Licenses, you know, how they license, what exams are they taking? We can't do anything without passing exams in various segments of the business. You got to get sample performance. That's something that's important. They could have model performance, they could have model portfolios where they actually publish their performance, or they could just have customized portfolios they do for individual clients. That's us. We don't have models. We're not sure we would like model portfolios. We like more customized, that each client really gets something tailored to them, especially with socially responsible investing. It's hard to have a model portfolio when I've got someone who wants to divest from fossil fuels on the one hand and someone else who's a vegan, or both. Right. And they've got all sorts of different requirements, and so how do I have a model portfolio? It's better to have customized portfolios. And how are they paid is always a very big thing, because there's been a huge sea change in the business from being like a stockbroker where you sold individual stocks or mutual funds and got a commission per trade, and being fee-based, which is you're getting an annual fee based on the assets under management.
Right.
And the reason, and the second one, I don't want to say, is a sort of a higher level of advisor, really, because they're fiduciarily responsible. They're fiduciaries, which means that the stockbroker is, or the regular representative, is just responsible that the investments that they make are suitable for what you ask them to do in that particular need. So I would like it to get me your best solar stock. Right. You know. And so, okay, I researched and I said, this is what you asked for, this is suitable for you.
This is what you got.
This is what you got.
Yeah.
The financial advisor who's fee-based has got to be responsible that this investment you're recommending fits within the total portfolio as far as risk and everything, and overexposure. I mean, you could already have a ton of solar stocks, and the other broker would say, well, you asked for a solar stock, here's the best one. And I know they're a good company, I believe in them. But the other one's going to say, look, you already have 30% of your money in solar stocks. I think we should not be putting it there. So a fee-based advisor is better, and this is why the whole business is really turning this way. And then you have to know what's their fee. I mean, what do they charge? And the fee should drop as your assets get larger. Just how it's done in the business. And what is the fee now? What is the expected fees going forward?
So are you saying?
Uh-oh.
Are you saying poor people probably pay a higher fee?
Oh, man.
It's okay if you are.
Well, not higher in dollar terms, that's for sure, but they're paying a higher percentage.
Got it.
Yeah.
Okay.
It's because, you know, really the reason is it's not, there's no agenda to do that, but it's just because really the amount of work to manage a lot of money is more than less. But it's certainly, you know, if you're researching a stock and you're giving it to someone who's got $100,000 and you're giving it to someone who's got $1 million, you know, you shouldn't be paid the same amount. Really, it's a lot of extra money over there for this one recommendation. So it makes sense, but that's just how it's done in the business. That the government heavily regulates this industry, and one thing the government does is they have a website where you can check out if an advisor has had social sort of trouble, legal trouble, complaints, et cetera. It's called Broker Check, and it's offered by the organization that looks over brokers and financial advisors, same group, same organization, called FINRA. And FINRA has this thing called Broker Check. You can go right online, just to look up Broker Check, and you can look your advisor up by name, look up their firm by name, and the government will say, look, here's all their licenses, by the way. Here's what they are registered to offer, and also if they've had any complaints and what the nature of those complaints were. So we often tell people that because they're not aware that there's some place totally removed from us that they can check us out.
So actually, if this was the first time I came into you, you'd probably say, and before we talk again, you should go.
We advertise
because I want you to see who I really am.
We advertise it, and the government moved in about, I think 3 years ago or something, and said from now on you have to put in any website where you've got, you know, Greenvest, our website. It has to be right prominently on the landing page. I forget what it is. This representative is evaluated in Broker Check. Click here. It has to have a link that people can click, which is great. And we have no complaints at all. So you know you have to be careful to not get complaints, and you do. But we have no complaints, so we actually promote it.
Yeah.
I mean, why not?
So when you don't see it, no, when you don't see it, yeah.
Well, if you don't see it there, then there's problems, trouble.
There's problems, right.
I will say something else very important is you want to know when you choose an advisor, where is the money going to be kept? Where is it going to be, they call it custodied? Where is it going to be custodied? Because you don't want your financial advisor to actually house your money. And that makes why some people are afraid of going to an advisor, because they think, well, I'm going to giving this person my money. You're not, because what should happen is that big or small, there's a separate entity, it should be a separate entity, that money is held, that is independent and does not release the money to the advisor. We'll never accept it. So
there's no mingling of funds.
No mingling of funds, but it is legal to mingle them. And Bernie Madoff did not have a custodian. That's why he was able to do what he did. And people don't know enough about custodians to think, oh, Bernie, where's your custodian? They just say, well, it's Bernie Madoff. And he has this reputation of never having a loss, which would have been a red flag right there. And so he was able to take this money and commingle and print out statements saying there's always been a return, and there's no one to look over it. No one to. The custodian produces our statements.
And is it safe to say the custodian, if the financial advisor crashes and burns for whatever reason, the custodian still has your funds safely kept?
Perfect. That's right. It's maintained there. It's insured there. We use our custodian is Fidelity, actually Fidelity Investments, because we are socially responsible, and we're not that large, but we wanted to have a big, solid, and they did wonderfully through 2008, as far as they're keeping everything together, and during the Great Recession, and all their cash accounts, et cetera. So the custodian is really important. You should always ask, where's my money being held? Go ahead.
And I'll just ask, okay, hi Todd, and where do you hold my money? And then you would tell me something. And then I'm just going to ask this, then how do I know what you've just told me is actually a good thing?
That the custodian's any good?
Right, because right now you told me Fidelity. And I went, Fidelity, yeah, I know that name. I feel safe now. But...
Well, you go to their website.
And then...
I mean, you can...
Right, and is there how do I check what you just said is actually...
That Fidelity's good?
Or not that the Fidelity's good, or that it's a good place where it's being held. It might have been, oh, I've got it at Tom's Garage. And you go, great. And then I'm going,
there's not that many custodians left, actually. They've been combining. But it's a good question. I never had that one before. How do I check out the custodian? I suppose Google?
I mean, Bernie might have said, yeah, I got a custodian, it's Tom's Garage.
Oh, I see. Well, how would you know that's true? Because it has to be on your website again. On all of my cards, the website, everything that the custody, clearing and custody provided by.
Got it. And then you could always go to Fidelity and say, hey,
do
you know Todd?
You could ask them.
And they would go, yeah, we know Todd.
You could ask them.
Okay. I'm just checking.
No, these are good questions. These are good questions. No one's ever asked that before because we're always using Fidelity. The big ones are Pershing is another one. There's a number of them, and the Bank of New York, who owns Pershing. So there tend to be, you want to go with the big reputables if you can.
Right.
So things about how to judge an advisor is whether you're going to get personalized attention, what's happening in a lot of this.
Does he take your calls?
Well, to take the calls, and is he just shunting you off to assistance or something, or is it? I guess it's fine, but I wouldn't want to be with a group that has a team advisor approach, which is like buying, clothes at LL Bean.
Right.
You call up and you say, I'll get back to you about that. I really like that jacket, but I'm going to get back to you. So you call the next day and you say, Jane, you there? And they go, no, this is Fred. I have all the notes from talking to Jane. Well, no, but they've got the notes and everything. But and believe it or not, in the financial world, there's actually some of the major firms are having these team approach like this. And I really, really like someone who knows me. How do they work their correspondence and access? In other words, how much are you going to get statements? Are you going to get trade confirmations? How do you get them? Do they have online access? And again, with I don't know if did I already say this, that in our particular business, you'd want an SRI advisor. So you want to say, do you specialize? Do you know something about social responsible investing? Because what's happened in this business is we're going to get to that in another episode, the next segment, which is why social responsible investing is growing so quickly. And I'm biased, obviously, but feel it's superior. But because it's growing so quickly, the major brokerages now are going, wait a minute, we're losing a lot of market share here, so we're going to start all these social responsible divisions. So some people have a problem, at least our clients typically do, that they have a social responsible division, but they're still making money the old way over here. Yeah. It's very convenient. They're not really affecting what they do. So does this person, is that all they do is social responsible investing, or is it just sideline? So last is, what should your current advisor be doing for you? So this is what people, so you hired an advisor, you decided you wanted him, or you inherited the advisor. When you inherited money, sometimes the advisor comes along with it, and what should they be doing? And so number one is they should be putting your interests first. That's the whole definition of fiduciary responsibility. The client's interests must come first. The way they trade, the expenses, how often they trade the money, how often, and it should always be in the client's best interest. So that's number one. The second one, you should have a clear agreement on your asset allocation. So you could do this roadmap together. We talked about all these questions, and so finally they say, look, it feels like your allocation might be whatever, 65% equities, 35% bonds or something. Your risk tolerance, you want to talk about that, and so we don't want to lose any money at all, just none at all. Well, that's a whole different, you won't be 65-35 then. But we can't take it emotionally. We know it'll come back, but we just, so that whole risk tolerance. So you want to know that this person, you have a clear, written down, this is where it's at. You want to have someone who regularly refreshes the portfolio. I mean, what happens?
What we sort of talked about.
Yeah.
Right. Are you paying attention to me?
And you're paying attention to me. And then, especially, this was really the problem. Not all wonderful stockbrokers, but when you're paid commission based on selling something, and it doesn't matter whether it does or there's can be that thing where someone will say, oh, I have $100,000, and the broker comes in, fills the portfolio nicely, and then, well, that's all the money there is there. I've got my commission. I'm sorry, but I've seen it happen over and over again in our business. We're fee-based, and you come into a portfolio which obviously has just been around since the dawn of time, and nothing's really happened. And so you want to make sure that they're refreshing it, they're doing the rebalancing they have to do, which is to get the allocation back to where it should be, and also bring in new opportunities. I mean, you shouldn't have to go to them all the time and say, well, what about cloud computing we talked about?
It goes back to that innovation thing we talked about 2 or 3 segments ago.
I've heard about drones. I mean, well, drones, unfortunately, there's military uses, so we can't invest in that. It's probably a bad example, but you don't want to have to go to them and prompt them all the time. They should be coming to you as well. And we're happy when our clients do come to us with something, because it could be a help to everybody. Right. They should be regularly available. If you're getting a hard time reaching them and the service isn't good and they're not, I mean, they're going to delegate some of this stuff to assistants and other people to get some sort of a withdrawal done for you. You can't expect them to do everything, but things should get moving, pretty quickly, especially these days with all this smartphones and stuff. You may or may not have decided that they can invest without getting approval beforehand. We typically work on a discretionary basis, so we have approval in the accounts to do the investing as long as the money stays in the account, which is that's why the custodian. But some clients say, I've given you that authority because if something really happens in the economy, or I'm out traveling or something, I know you can act. But really, I want to know what you're doing beforehand.
Right. In a non-emergency situation, just keep me in the loop.
Let me know what's going on. So if they've asked you to do, if you've asked them to do that, they should be doing that. It's not suddenly start trading. They should have an annual review. You sit down, or more and more it's on Skype or even on the phone, and you look at the performance report. It should be at least an annual performance report, and that you go over that, and you sort of look at the next year, and it's a checkup. It's like a physician's checkup. It's a checkup. So they should be doing that, and they should be volunteering to do it. You shouldn't have to pull teeth to get that done.
Right. Gotcha. Now.
And we talked before, they should be helping you save on taxes.
Yep.
Not all the time. Now, legal disclaimer, we're not responsible for taxes because that's an accountant's thing. We're not responsible for making sure every investment we do is as tax efficient as it can be. But we should be. That's it. We should know what we're doing in that. And we should be coming up with ideas for you to do that.
Right.
And save on the next thing, which is we should be providing the lowest expenses possible, especially trading expenses. We should be using mutual funds like it's institutional class that have the lowest, their lowest internal costs. We should be using exchange traded funds where it's appropriate. We should be cutting down on the actual, trading costs. So we need to be paid, but within that spectrum, any unnecessary fat, should be cleaned out.
Right.
Right. And this is, some have it, some don't, but it's nice if you have a financial advisor who can help you with financial planning as well, which we do. But if it gets very involved, we do bring in other folks, and especially if it gets into estate planning, we don't know how to do that. But
Right.
we should be, what we do, when we see estate planning is required, like a trust or there's some sort of thing where people are talking about their heirs, we'll say, really, you need to talk to an estate planner. You need to set up a trust. You're also kind of shepherd that or introduce them to an estate planner. So typically the best advisors that I've found and what we try and do is you're working with a team in the end, especially with someone who's got significant assets. There's us, there's a estate planner, there could be a financial planner if it's really complex, and then we're over here actually managing the assets.
Right.
So there's a whole team of people. And one more thing I do want to mention is that if you are wanting to get into social responsible investing, can your current advisor do that or not? I mean, you say, what is your current advisor doing for you?
Because not everybody does that.
And not everyone does that, so that's the lesson. We've talked a lot about that, though, about SRI.
All right, so folks, there's no excuse for not knowing the things you should look into when it comes to a financial advisor. I think we've covered that pretty good. In our final segment of this series with Todd, the final segment is going to be what?
Well, we're going to talk about social responsible investing. We're going to have because I've hinted at it here and there. I wanted to just talk about general investment concepts and principles.
Yep.
But now, for those who are interested, we're going to talk something about SRI, not the basics per se, but why is it the fastest growing segment of the financial industry today, which is what's happened. So why is it?
Okay, thank you so much.
All right.
Hey, we'll see you next time. Thanks out there.